Good morning. This is Andy Cates from the Global Economics Department at UBS. Financial markets continue to look toward Washington in the hope that U.S. politicians will eventually realize that they're not actually playing with sticks of candy, but are actually playing with sticks of dynamite. The optimism concerning passage of the TARP legislation has faded after Paulson rejected an insurance scheme that had been proposed by the House Republicans. And Senator Barney Frank, the chairman of the House Financial Services Committee, has been suggesting that if this stalemate continues, there will be no bill. And this in turn has naturally led to risk being taken off the table again, with Asia's equity markets overnight weakening across the board, while U.S. Treasuries have been receiving renewed bids. In other news, J.P. Morgan has bought the deposits, assets, and certain liabilities of Washington Mutual's banking operations in a government-brokered deal. Though this appears to have gone largely unnoticed in the markets, perhaps because this type of consolidation in the industry is now par for the course. Many macro observers, meanwhile, have been fretting about the impact of a bailout plan on the U.S. economy's debt and deficit mathematics. While nothing is assured at the moment, particularly after the latest stalemate, the estimates that have come to the fore so far suggest that the U.S. fiscal deficit might nearly double in size over the coming year or two, possibly swelling to between 6 and 7% of GDP. The Paulson plan also suggests that about 10% of U.S. GDP might be added to the stock of U.S. government debt. Note here, though, that these numbers are very similar to what actually emerged in the initial years after the first Resolution Trust Corporation was founded back in 1989. Note, too, however, that after that body was sanctioned with legal power to buy up toxic debt, it took 1 year for the U.S. equity market to find a bottom. It took 2 years for the U.S. economy to find a bottom. It took 3 years for the U.S. housing market to find a bottom. And it took 4 years for U.S. long-term Treasury yields to find a bottom. The U.S. dollar, incidentally, was fairly stable against many major currencies in the months and quarters in the early 1990s, and more broadly appreciated on a trade-weighted basis. The bottom line is that even if a bailout plan is passed, it will still be premature, in our view, to sound the all clear about U.S. macroeconomic fundamentals. We can only hope in the meantime that U.S. politicians offer that option. As for the day ahead on the macro front, the U.S. faces the final estimate of U.S. GDP growth for the second quarter, which is expected unrevised from the last estimate of 3.3%. Most of the forward-looking data, of course, suggests that the economy is on course for a contraction in the current quarter, and many in the market might therefore ignore the latest numbers. The U.S. also sees the final estimate of September's Michigan Confidence Index, with a consensus, rightly, in our view, anticipating a downward revision from the first estimate earlier this month. Elsewhere, Europe sees some final CPI stats in Germany and some consumer confidence numbers for France. Overnight, in Japan, September's inflation numbers from Tokyo were somewhat higher than expected, even though the August data at the national level were in line. Suffice it to say that we don't think inflation is much of an issue right now, with the world economy coming ever closer to the brink of recession. That's all for today.